Hi there, I'm local billionaire boy Rowan Moneybags, and I've got loads of money. I've got a mansion, I've got a mega yacht, but I want more. Perhaps I need some help to invest my money.
Well, Rowan, even if you leave the complex stuff up to expert investors like me and Will, it's always a good idea to understand the basics of investing.
Any investment involves a level of risk, so it's important to understand how to invest appropriately.
There are 5 main types of investment you can make. These are bonds, stocks, property, commodities, and unusually, cash. Let's look at stocks first.
Stock is just a term for part of a company. If you buy stock in a company, you bought some of that company's shares, which effectively means that you are an owner of that company.
We can classify stock based on its value, formerly known as market capitalisation, or cap. Large cap companies are companies worth over 10 billion, such as Apple or Disney. Whilst all stock is risky, investing in large companies is usually the least risky. However, buying a share will cost you more money.
Below the large cap companies, we have the mid cap companies, which are worth between 1.5 billion and 10 billion. These companies are smaller but still well established, and investing in these companies involves more risk but isn't as costly.
Finally, we have small cap companies, worth under 1.5 billion. Although these are the cheapest, they usually pose the greatest risk.
There are a couple of ways you can make money from stock. Firstly, you can make money from buying and selling shares. If you bought a few shares in Apple for €150 today, they might be €151 by next week. You could therefore sell your shares and make €1 profit on each share you'd bought.
If you were to buy a share in Apple 10 years ago for €25, you'd have made a massive profit right now. However, if next week the share price dropped from €150 to €15, you'd have made a massive loss. See these fluctuations in the value of a share, which determine how much profit or loss you'll make. The value of a share can dramatically increase or decrease for many reasons, which is why investing in a company is inherently risky.
The second way that investing in stocks can make you money is through the yearly profits a company distributes amongst its shareholders. If you've bought more shares, then you can typically expect a higher proportion of the profit paid to you from the company as dividends.
Now let's look at bonds. Bonds are just a loan from you to a company or government. You, the investor, buys a bond from an organisation, which is a promise from that organisation to repay you over time with interest on the original amount.
The longer the term of the bond, the riskier it is, because the value of the bond is more likely to change as the interest rate changes. In general though, bonds aren't as risky as stocks.
Now we'll look at cash! It may seem odd that simply holding on to your money can be considered an investment, but it's part of what's known as a stable value fund in the investing world.
Cash is considered relatively stable because there's very little risk that the value of your money will decrease unless the currency collapses. Over long periods, however, inflation may decrease the value of your currency. For example, something that cost €1 in 1999 will cost €1.42 today because of inflation.
The 2 remaining types of investment are commodities and property, though these are fairly self-explanatory. Rowan bought a castle a while ago, but he could sell it for more now. Rowan bought some gold a while ago, but he could sell it for more now.
Now that you've heard about the 5 asset classes, it's up to you to decide what to invest your money in, perhaps with the help of financial experts like me and Jaden.
The accepted best way to invest your money is based on modern portfolio theory, which recommends diversifying your investments, which basically means don't put all your eggs in one basket. You should spread out your investments as a mixture of stocks, bonds, cash, commodities, and perhaps property.